Good day, I'm Martin Gagel with Market Radius Research. It's Monday, January the 16th, 2023. We've got CEO Steve Dalton of Revolve Renewable Power joining us today. Revolve is a developer and operator of wind, solar, and battery projects in the US and Mexico. Steve's here to discuss their recent news of the sale of 1,250 megawatts or 1.25 gigawatts of utility-scale solar and storage projects with us today. But please remember, this is neither a recommendation nor investment advice. We're here about to learn about the news and the company. Steve, thanks a lot for joining us today. That's seems like a pretty big bunch of projects you're selling there. Can you give us a quick overview on of the news release and the transaction?
Yeah, sure. Well, great to talk to you, Martin. It's been a busy couple of months, obviously, since we spoke to you last. So what we announced last week now at this stage was the sale of two of our more advanced projects in the US. So these are two solar and battery storage projects. The first one is the Bouse project located in Arizona. That's 1,000 megawatts. We started development on that around just the start of 2021. And the second project is a 250 megawatt project just located north of actually the Bouse site again in Arizona. And we started development of that around Q3 last year. So we've announced the sale of those two projects to the kind of global energy company ENGIE, a big French company, very active in the US, Mexican, and actually the Canadian market as well. So yeah, no, we're delighted with the sale. I mean, it was one of our key objectives for this year. We didn't quite expect to get it done as quickly as it's happened, but yeah, no, overall we're really happy with the deal that we've done. So
there's not too many details in the news release itself, some confidentiality in there. You get $2 million up front here, and then there are staged payments along the as the project develops out. And I guess the first of those milestones with payments is expected this year. Why not take the payment, all the payment up front now? Why sort of stagger it out for at least 1 year or presumably multiple years going forward?
Yeah, well, I guess, Martin, this is kind of consistent with the approach that we've taken really since we've been set up as both a private company and then obviously important to do this as a public company. But in general, we like to do deals where we continue to take the development risk. And really the reason for that is to try capture as much of that development value as we can for shareholders. So structuring a deal like the one we've done allows us to do a couple of different things. It allows us obviously to take some cash off the table and bring that back into the company, which is obviously always very important. And then it allows us to capture some of that development value as the project continues to progress through all the way up till commissioning. And it aligns, let's say, a company like ourselves along with, in this case, ENGIE, to show that we're willing to take that risk and share in that value. So I think it's important to do it that way. I mean, you could certainly sell these projects at this stage and kind of walk away. But I think the market for that would see you probably not take that much value off the table. So it's important for us, and we're obviously a developer, so we understand the risks that we're taking. It's part of the core part of the business. We've been doing it for a long time. So we're very comfortable with kind of structuring deals like this, particularly with kind of global companies, as I said, like the likes of ENGIE.
So in short, if you took all the payment now, you would get presumably a lot less than if you hung on to it over the development cycle and took payments further on down the development process. Is that in short how it kind of works?
That's in short. And I mean, I think when we done the previous interview back in probably November at this stage, I think I gave an example of take a greenfield site at the edge of a town where you go and you get it rezoned, and then you get kind of permission from your local county. So it would be equivalent to selling a site maybe that you've just got rezoned, but you haven't got permission off the county, or you haven't got the utilities or services in. There's obviously value increments as you kind of bring it through those steps. And the flip side of that is you lose value, obviously, if you don't bring it through those steps. So what we try to structure is a deal that takes some cash off the table now, so de-risks it from that perspective, but also, as I said, shares the risk along with ENGIE. So we kind of try capture some of the value as you bring it through those further steps and de-risk the project.
They've now purchased 100% of the shares of those projects. Do you have any work or expenses to do as they develop? Presumably you'll consult with them or something, but you're not actually investing more at this point in material time or money into these projects, are you?
Yeah, that's correct. That's correct. So the structure of the deal is they have bought 100% of the shares in both of the project companies. They're fully funding all future development costs, all financial security that's required for interconnection and whatnot. Obviously, from our perspective, we hope to remain involved in the background, assisting them where we can, because it's in our interest to make sure the projects obviously get through development, that they're successful, that we're successful together. So we certainly won't, let's say, won't be walking away from the projects completely, but it'll be Engie who will be driving on with the projects, both in terms of time and cost.
Gotcha. You're not able to talk about how much you expect to fully realize from it. Are you able to give any indication as to how much you've invested into the project to date?
Not specifically when it comes to the project, but I think what we have said to investors and tried to kind of point them back to is the illustrative case that we've laid out in our investor presentation around the types of returns and investments that's required for these types of projects. I think in the case of our presentation, we had outlined, I think, a 200 megawatt kind of illustrative investment case. In terms of development costs, you actually don't really have to increase those costs too much just because you're doing 1,000 or 1,250 megawatts. You can actually get a lot of leverage off the same amount of investment dollars for a 200 megawatt project versus 1,000 megawatts. So the amount you invest certainly doesn't go up incrementally at all. You will have some kind of smaller incremental costs, but it's very, very small in the grand scheme of things.
Sorry, and just to clarify that, so when you're doing the development, when you're applying for permits or doing an engineering study or an environmental impact study or whatever, like it takes as many engineering hours or consultant hours to do it for 200 as to 500 or 1,000, maybe a little bit more, but not 1,000 megawatt project isn't 5 times as much as a 200 megawatt project. Is that what you're saying?
Yeah, that's exactly it. Particularly in the early stage development. I mean, if you look at the size of the land required, I mean, you may need 1,000, 200, 300 acres for a 200 megawatt project. You need 6,000 for 1,000 megawatts. The cost of getting that land, particularly in the case of BOUS, from a federal land perspective, isn't that great. You could be talking about $40,000, $50,000 extra. The cost on interconnection in terms of interconnection fees doesn't change actually at all once you get up into the much larger numbers of kind of 300-400 megawatts. The difference between that and 1,000 is negligible. So you can spend the same amount of money on a 250 megawatt project as you would a 1,000 megawatts at that early stage. Obviously, as you start to bring it through construction, the costs do multiply a bit, but at the lower end, not so much.
All right, and I guess this is your model to sell off the project. You're not in it. Energy, not to speak too much of them, they finish developing projects and own projects for a longer period of times, and but your whole model is to develop them fully or partially, sell them off, take that capital, reinvest it in developing new projects because you get the most leverage return on investment off of bringing it from the nascent stage to further developed. So this is right on a typical business scenario that you normally do?
Yeah, that's exactly it. I mean, it's in the case of, let's say, the BOUS and Parker project, you're talking about $1.5 billion worth of investment. So for a company like us, we're always going to require a partner at some point to kind of pull a project like that off. Our current model is obviously to focus on development. We may transition out of that, and that's why we're doing some of the things on distributed generation where we're looking to own and operate assets. But on projects of this scale, it definitely makes better sense for us to kind of bring in that partner to help us develop the project and then obviously commit the capital to get it into construction.
Okay, so this is what it says to me as an investor is that you have numerous projects in various stages of development in your pipeline. You don't need to go back necessarily to the market to raise equity to fund your ongoing developments. Your assets are liquid to some extent, where you can find buyers for them, sell them off. They clearly have value. And then you sell them off, and then you recycle that capital to reinvest and rinse and repeat, so to speak.
Yeah, well, again, like I said earlier, that's what we've done historically. We raised money in 2012 as a private company, again in 2014, and we didn't raise any further money up until we done the RTO. We funded through selling projects. Okay, as part of the RTO, we obviously raised some money to really aggressively expand the business into the US. This is now the kind of first fruits of that investment, if you like, that we've been able to exit out of some of the early projects that we started development. And we've been able to take some cash off the table, which we'll be able to reinvest into obviously running the business, expanding the rest of the development pipeline, and doing other things in terms of distributed generation. So that's historically always been the model. Obviously, as a public company, important to get that first deal done where we can kind of show that we've kind of been able to do it, been able to deal with, as I keep saying, kind of large companies in the energy space, and kind of pull off a similar transaction that we've done before. So that's certainly the model. As I said, we may transition into more of a longer term kind of cash recurring business over time, but for in the short term, at least when it comes to these size of projects, I think the deal like this makes sense for us.
Can you give us any sort of level of expectation of the cadence of these type of deals? Should we expect like one or two of them per year? Or what would be sort of the general rate of selling off a portion or seeing a transaction like this come from you?
I wouldn't put, let's say, a number on it per year. I mean, I think if you look at what we're looking to do more kind of medium and longer term, is we are looking to transition into that business that has long-term recurring stable cash flows for investors. So ideally, what we would like to do is, as we start to sell some of these larger development assets, recycle that cash back into potentially holding some of the smaller projects that we have under development ourselves. So it may not be a case that you'll sell every project we have under development. We may try to hold and build and operate some of these ourselves. We have in our portfolio, in particular, we have the Vernal BES project, which is a 80 megawatt hour battery project that we're pushing on quite strongly with. That's in Utah. We have another 50 megawatt wind project. Those projects are definitely within the realm of projects we would like to think we could do ourselves. Obviously, we have some other larger projects that are again in the hundreds of megawatts. So you kind of have to make a decision as you start to bring them through development as to what you would do with them. So it's a case of just looking at every project, looking at obviously the stage of the company where we're at, and making decisions around it. But I think what it does show is that if we either choose to or need to, you can realize some value from these projects at an earlier stage than people would maybe think otherwise, if you like, in terms of having to have them at construction ready. It's not a necessity.
And as well, you don't need to hold on to the whole project. You could just carve out, like own a piece of it and partner with someone else who puts it in. So you don't have to put up the whole funds yourself and have the whole project financing risk on your shoulders.
Yeah, exactly. I mean, I've always said, like, once you have the project and you're bringing it through development and it looks like it's going to be a good project, then you have all the flexibility to do different types of deals and different types of structures.
Yeah.
Like you said, either sell outright, hold it, try build it, or sell a minority down, hold a minority share, or different kind of structures. So the main thing is to have kind of high quality projects that actually have a chance of getting through all the way to being constructed and operated.
And that is more of the model, or of owning and operating, is more of your distributed generation business that you bought. That's more core to that business, while the utility scale is more tendency towards selling them off as they get further developed.
Yeah, as things stand today, yes, but I think over time you would like to be holding some of these assets and building them and operating them ourselves, if you like. It's just a case of trying to balance the equity and capital required to build some of these much larger scale utility projects with the kind of where the company is currently. So like I mentioned on Bouse, that's a fairly sizable investment, 1.5 billion or thereabouts. That's something that we're not going to do ourselves. But for a 50 megawatt project where the capex might be 60 million, 70 million, then okay, it's more in the range of maybe something we could do along with the typical project financing and other structures that go along with it. But that's all to be kind of decided as we move through it. I think the main thing is get the projects through development, hit the milestones, and then kind of reassess what you do with some of the utility scale ones.
Not to get too off topic here, too broad, but when you develop a project, what is the typical sort of debt to equity kind of ratio of it? Let's say for a $50 million project, how much equity would you have to put in versus sort of debt funding into it?
Yeah, it really depends if it's in the US, if we're using tax equity, if it's in Mexico. So it generally it really depends. It depends on the commercial structure, whether you have long-term contracted revenue, whether it's merchant finance. So it's hard to kind of give a one straight answer. I mean, you could see everything from 60-70% all the way up to kind of 80% plus on debt financing, just depending on the commercial structure that sits around us. But that's generally where it's at. Obviously, the US has tax equity that comes into play as well. So there's a few different dynamics there.
Okay. And one final question here before we wrap it up. It sort of incorporates, maybe it's two questions. Interest rates have risen, which sort of big project, long-term projects, it changes the financing dynamics of the rate of return on capital. And then as well, the Inflation Reduction Act with all sorts of subsidies and incentives for renewable generation. How have those have kind of coincided at the same time? How have those changed the pricing or the interest or the dynamics within renewable wind, solar storage projects?
Yeah, well, maybe I'll deal with the first question. In terms of interest rate, it's actually an interesting one. Like I would say short-term interest rates have gone up, but normally what that does is drives the back end of the yield curve down. And typically these are kind of 10, 15, 20-year financing structures. So okay, they have gone up, but they haven't gone up as much as you would think when you look at the front end of the kind of yield curve. And certainly the last time I looked at them, the back end had certainly gone off at the other end, so it started to come back down a bit. So not as much of an impact maybe as you would think, based on a lot of the headlines around interest rates and everything. So it depends on your financing structure. If you're based on floating rates and you're a big utility, that's probably going to hit you all right up front. But a lot of developers like ourselves would generally have long-term fixed financing in place based off kind of 15-year swap rates, which haven't been maybe as volatile as the front end of the curve. In terms of the Reduction Act, there's I guess a good few things in there. In terms of wind and solar, all it's done is really extended out the kind of tax credits and given people a lot of certainty. It has brought battery storage projects into the mix, so we've kind of yet to see exactly how that plays out, but that definitely will be of interest to us there. And then there are other aspects to the act that I wouldn't say counterbalance, but you do have to take into consideration as well. Like there's certainly union labor kind of rules and regulations that allows you to access certain parts of some of the incentives that are there as well. So there's a lot that goes into the act. Let's say that we're still kind of working through as we kind of bring the projects through development and are really starting to look at financial models and returns and everything else. When it comes to projects like Bouse and Parker, fortunately, we don't have to necessarily be too concerned because it's for the likes of NG to kind of do that analysis and weigh it up. I think, and I might have made this comment when we spoke last, I think what it certainly has done is has driven the demand for projects, for development assets, because there are more entities and companies now coming into the market because of that long-term kind of investment picture that it's kind of set out for the industry. So I think there's a lot in it, if you like, but all generally positive.
Okay, so generally net, it's showing more demand for projects and should spur development and construction of these projects.
Yeah, no, definitely. I mean, that's what it's intended to do, definitely. So I think for developers like us, if we can continue to add further projects to our pipeline, continue to bring them through development, there are, I would say, a larger pool of investors that are there now looking for those types of projects.
Okay, great. Steve, thanks a lot for bringing us up to date on that news and giving us a sort of a refresh. We went a little broader than just that news release, so I appreciate that, getting us up to speed. Thank you very much.
No problem. Thanks a lot, Martin.
Cheers.